Before we start today's show, I just wanted to mention our sponsor, Wealthify. Wealthify is regulated by the FCA and is a multi-award-winning online and app-based investment service founded in 2016 and owned by Aviva, with a simple mission to make investing accessible to everyone. You can invest from as little as £1, and Wealthify offers a number of investment products, including a stocks and shares ISA, a general investment account, and a personal pension. However, Wealthify also offers a junior ISA, which allows parents to save for their child's future through investing. Wealthify also offers ethical junior ISAs and the ability for family and friends to pay directly into its junior ISA account for the child's benefit. In the run-up to Christmas, this could provide a meaningful and eco-friendly alternative to present buying. With investing, your capital is at risk and you could get back less than you put in. For more information, head over to moneytothemasses.com and search Wealthify. Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, at the end of last week's show, I warned to keep an eye on bond yields as a seemingly new trend had appeared to be gathering pace in the bond market, fueled by surprisingly dovish monetary policy decisions from the US Federal Reserve, the Bank of England, and the European Central Bank, the ECB. Now, in previous weeks, bond yields had tumbled. For example, the 10-year US Treasury yield had fallen from 1.67% to a 6-week low of 1.43%. Similarly, the 10-year UK gilt yield had fallen from 1.21% to 0.82% over the same period. With so many investors betting against bonds, the rally in bond prices, now remember, bond yields move inversely to bond prices. This caught a number of institutions off guard and brought about a spot of short covering. This is essentially where investors reverse their bets that bond yields will keep rising by ultimately having to buy bonds to do so, pushing the price of bonds higher. Now, this is a vicious circle of bond buying that drives the market higher and higher in what is known as a short squeeze. But when the overarching driver of a market move is a short squeeze, the reversal of the squeeze when the full sellers run out can be just as dramatic as the initial surge that started it all off. This reversal occurred after last week's show, just as new inflation data from the US showed that inflation had climbed to 6.2% in October, making it the fastest year-on-year increase since 1990. Now, that in itself wasn't a shock, but when combined with a fall in demand for bonds, even from forced buyers, this caused the 10-year US Treasury yield to explode higher to 1.646%. Now, we saw a similar, albeit less dramatic move higher in the bond market in the UK. So the 10-year UK gilt yield, for example, attempted and failed to break and hold above 1%. Now, even the news that UK inflation has hit 4.2%, which is the highest in a decade, was met with little reaction from UK bond investors, as it appears that high inflation and ultimately high interest rates are already baked into the market pricing. But ultimately, bond yields on both sides of the Atlantic and further afield, to be honest, are still in an uptrend, even though they appear to be entering a period of consolidation as investors hang on every word and action from central banks in an attempt to front-run the next big market move. Now, similarly, the situation in equity markets has been one of consolidation within an overall uptrend. If we look at the S&P 500, it has pulled back a little bit from its all-time high of 4,701 on the 8th of November to sit at 4,688 as I make this video, but that is not particularly noteworthy in itself. Now, 4,700 is a psychologically significant barrier to break, but some technical analysts think that it's only a matter of time before this is in fact broken and we head towards the 5,000 level, perhaps as early as the end of the year during the seasonal Santa rally. Now, if we jump across to the UK, the FTSE 100 is still hovering around 7,300, while the Euro stocks and the DAX in Germany continue to pursue new all-time highs, despite a concerning fourth COVID wave emerging in Europe and in particular in Germany. But while markets are still trying to position themselves by second-guessing central bank policy, in the absence of any new information, they are also starting to place bets that there will be a possible divergence between key central bank policies as each juggles higher inflation with economic growth in their respective economies. Now, no clearer can this be seen than in currency markets. And in recent weeks, the pound has tumbled from $1.35 to as low as $1.34. And the last time I said, keep an eye on the September low around about $1.34, because if that falls, then we could be heading down towards $1.31. And although the pound has strengthened back towards $1.35, we're not quite out of the woods just yet. And the reason for the continued weakness of the pound against the dollar is that despite both the Bank of England and the Fed keeping interest rates low, the latter has already started tapering its QE program, which at least signals its intent on tightening monetary policy. The Bank of England so far has been all talk and no action. Now, in Europe, the euro has fallen in value against both the pound and the US dollar, hitting a 16-month low against the latter. Now, that's because markets are betting that the ECB will resist raising interest rates even when the Bank of England and the Fed do. Now, the market has started to realise that not all three central banks will or have to move at once, and institutional investors are beginning to adjust their positionings. It means that we could see a repricing of assets too, not just in currency markets, if the narrative continues to gain traction. Now, going back to government bond markets, perhaps this explains the strong rebound we saw in yields in US Treasuries at the same time as a more contained rally in UK gilt yields. Now, the message really from this week's show is don't be surprised if a divergence in central bank policy becomes a major investment theme going into 2022. Now, that is it for this week on Damien's Midweek Markets. As ever, you can contact me via email. Damien@moneytothemasses.com is the email address. Twitter, money to the masses with the number 2. You can obviously find us on Instagram, TikTok. Don't forget to look for us on Facebook, join our group, and also don't forget to subscribe to our YouTube channel.